right. Well, hello again, everyone. Welcome to the HLC Equity Market Update webinar, where we'll discuss the real estate market in the second quarter and our performance, as well as kind of what we're seeing for the rest of 2024. My name is Kevin Ashman. I'm the Director of Marketing here at HLC Equity, and I'll be hosting today's discussion. I look forward to an insightful conversation with our panelists. So introduce them now. I'm joined by two members of HLC's leadership team who join us regularly on these webinars. Cesar Nguyen is our Director of Acquisitions, who is responsible for identifying and evaluating all of our investment opportunities. Also, we have Dave Molitor, who's HLC's Head of Operations, handling all levels of ops at our managed properties and also internally on a corporate level. So a quick outline of today's agenda. We'll start with Cesar, kind of speaking to some of the more recent economic and market trends and how that's really impacting our acquisition efforts. And then Dave will walk us through kind of an overview of our operations, property management, and the kind of the performance over the last quarter. And then finally, we certainly want to make sure that we leave time to answer some of your questions. Excuse me, as they come up throughout the presentation, please feel free to drop those into the Q&A module at the bottom, and we will address those towards the end. So without further ado, let's get into it. Cesar, excuse me, why don't you talk to us a little bit about what you're seeing over the past period in terms of the overall market and investment opportunities?
Absolutely. Thanks so much, Kevin. And welcome, everyone. Thanks so much for joining us today. I would kick it off with overall macroeconomic environment. So what do we see out there? If you go to the next page. Just high level, I think the biggest news out of Q2 is the Fed signaling the willingness to cut interest rate. In the latest meeting, Fed Chair Powell, he have indicated that the time is for adjusted policies now, which is great. So the entire Treasury market had priced in the interest rate cut, and this has happened recently. But during Q2, as you look at the Treasury chart here, this was from May into July, the market whiplashed quite a bit in terms of the movement because they wasn't sure whether the Fed will reduce rate, and with a lot of mixed signal in the economy overall in terms of corporate earning as well as the labor market. As a lot of mixed signal, there was quite a lot of weak labor market data that point to rate cut, but then corporate earning was still stable. So people, a lot of focus was sure whether how the Fed will reduce rate. But from our perspective today, where we are today, I think the chance of Fed rate cut in September is quite high. And now the question in everyone's mind is whether it be 25 bips or 50 bips. And that's really bring a lot of optimism in the investment sale market. As you can see, of the last quarter, the investment sale volume has shown sign of recovery. Q2 of 2024 is up 15% compared to last year, and 42% compared to from Q1 of 2024, which is great. And from my perspective of what I see, a lot of volume, a lot of BOV from broker, and a lot of deals came out, and a lot of deals in the first half of 2024 was mainly loan assumption options. Just because a lot of those are fixed rate debt, is quite attractive for the next buyer. But now we've seen some deals that are more on a free and clear debt, because if you go out and buy a new deal today and put on agency financing, you can, with rate buy down, you can get a 5% fixed rate debt for a 10-year loan, which is quite attractive for the next buyer. So that's got to incentivize seller to sell and buyer to stress to transact. So if you go to the next page, in terms of other market that we track, we see some optimism in terms of as a gap between supply and demand are closing. You can see the chart on the left here here is the gap of all the multifamily unit in US. In 2022, there was a negative absorption going on because the amount of supply coming online was so much that even though there's a strong demand, they still will not be able to absorb these unit. But as you can see in this black line there, that gap is closing in and it start to going toward zero, which is good. And you look at the amount of supply, look at the chart on the right, which is the amount of new unit coming online in major Sunbelt market, Dallas, Austin, Charlotte, San Antonio. It's a bit hard to see, but we will share with you this slide after the webinar so you can have a better look. But the high level, if you look at the amount of supply coming online, this is 2024 to 2026. The bulk of the supply of the delivery is peak at 2025 and it drop off afterward. So from our perspective, obviously with newer delivery, those buildings will have take a lot longer to lease up. But once we get behind 2025, go into 2026, the amount of demand will start to, we'll start to see net positive absorption, and the market will go back to normal again. So that is kind of our house view on if we go out and buy new delivery today. That's what we'll have to adjust. And for my conversation with other player in the market, it's the same. Especially in Sunbelt market with a lot of supply coming online, like Austin and Nashville, everyone is expecting muted rent growth. Somewhat, even in some instance, in sub pocket would be negative rent growth and elevate concessions just to work through the supply crunch. After that, they will start to see higher than normal rent growth, like 4 or 5%, because of the amount of demand from renters in this area. Next page. So another point of optimism that I have alluded to earlier is cap rate. This is the survey of cap rate from CBRE, and you look at the chart on the left. From Q4 2023 until Q2 of this year, we start to see 3 consecutive quarter that cap rate has stabilized around 5 cap across the board, and that is a great sign, because before that cap rate was we saw cap rate expansion every quarter, but now it has stabilized at the same level, which point to us that market has we found the bottom essentially in terms of value, for new acquisitions. And when they go out and survey buyer in all major metros, if you look at the chart on the right, average cap rate is 4.97%, which is in line with our conversation with major broker in all the major market. Class A in prime location is usually between 4.75 to 5 cap. Class A in secondary location is around 5 to 5.5, depends on the location, and Class B is 5.5 to 6. So that's that's what we see today. If we go out to buy deals, in major market, that's where market is pricing, in terms of valuations. And if you go to the next page, and one of the reasons why is that we see major institution, major private equity firm start to deploy that dry powder that they've been putting aside. Q2 we saw a lot of major transaction. Blackstone bought our Air Community for $10 billion. They took them private. Brookfield bought a $1.6 billion portfolio from Starwood. KKR bought a $2.1 billion portfolio from Quatera, which is a development arm of Lennar. And Equity Residential is interestingly bought a $1 billion portfolio from Blackstone. So we saw Blackstone both on the buying and selling side, which is a great sign of market getting back to normal. And and a quick data on this transaction. So Blackstone purchase from Air Community is about 5.5 cap. Brookfield is about 5 cap, KKR is about a low to mid 4 cap, and EQR was a 5 cap transactions. And these are all Class A property in prime locations. So we start to see major players indicating that they are willing to deploy capital to lock in Class A deal at a good location for 5 cap because from their point of view, we are at the bottom, and now they are able to buy good asset at 20 to 30% discount from the peak, at a significant discount to replacement cost. They are all basis player, and they want the lock-in deal in good location and wait for the market to come back to normal. And some of them, other than that, some of them is also a portfolio reallocation play. For example, equity residential, they have the bulk of their portfolio is focused in coastal market, and they want to diversify away from that. So they bought a lot of property in Georgia, Colorado, and Texas to diversify their income, which is a great way to look at how to deploy the capital efficiently. And we certainly see that as a green shoot, supporting the capital market overall. Going to the next page. So kind of going forward, what we are focusing on. Here's a chart that I think is quite interesting. That is a research from Newmark and RealPage collaboration, looking at about effective rent growth in the top 50 metro in the U.S. The chart is a bit small, but kind of high level takeaway of this is that on the left side of the chart, where you see positive rent growth, they're all in the Midwest market. And this is a market that they did not see a lot of supply coming online over the last 3, 4, 5 years because rent was not quite there to justify development. And rent was somewhat affordable, and that's allowed this market, the owner in this market, to drive higher rent. And the right side of that chart is all Sunbelt Metro. The typical candidate: Austin, Atlanta, Raleigh, Charlotte, Dallas, Tampa. All market where you saw a lot of supply, and now they have to work through that that supply crunch. And that in turn impact rent and have negative rent growth. So it's just a supply and demand story. Go to the next page. So for us, we continue to stay bullish on our thesis of kind of barbell approach, income and growth. On the income side, we focus on Class B workforce housing, and we buy deal at 6 or 6+ cap, depends on location. And then on the growth side, we're looking for Class A apartment building that we plan to buy from developer or a newer vintage deal that are within less than 5 years old. Whereas in a major metro that having a lot of supply crunch, where we can buy at a good basis, and we just bake in conservative rent growth, elevated concession to wait for this supply crunch to finish, and then you own a good asset at a good location at a good basis. That is still our thesis, and we believe that's the way to generate good return for our investor. And that's we've been disciplined in looking at deal, and we start to see a lot of interesting deal like that now. We start to see some distressed asset coming from owner that they cannot afford to hold on to the deal anymore because the loan's coming due, and they now have to sell at a discount, which is getting excited. And if you see the map on the right here, this is a report from Freddie Mac that I thought is interesting. It is not on multifamily, but it's on housing. And kind of high level of this map is the market in greens that you saw. House price grew within the last 5 years, since 2019 until now, and the majority of it is in the Sunbelt market. Primary Sunbelt market. And you look at the overall housing landscape today, how prices are at the record high again. If people want to buy home, the cost of owning home now is far outweigh the cost of rental. The gap is about $13 to $14 a month between the difference between renting or owning versus owning. So people cannot afford to own anymore, so they have to rent. So us as a multifamily owner, will continue to focus on market that have positive job growth, positive population growth, and also elevated housing price. That's where we'll see the strongest demand in terms of housing for renters, and that's where we'll start, sourcing deal for us, and to get and it could be major metro market like Dallas, Atlanta, but also could be a lot of secondary market that you see here, where there's a lack of housing stocks, and also the very expensive housing that people now they have to still, they have to stay within an apartment for longer. So that's where we are today in terms of overall capital market and opportunity. We are actively putting a lot of offer. We've, sent out 2 to 3, sometimes 4 offer a week on multifamily deal across the Sun Belt. And, I'm fairly optimistic that we'll start to get to something, a good deal for us very soon. So I stop there if you have any questions, and also kind of transition to Dave to talk about our portfolio performance. Thank you.
Yeah, thanks, Caesar. Appreciate it. Good afternoon, everyone. Kicking off with property operations. If we can move to the first slide there. Yeah, so I want to start off by discussing, leasing trends in the broader DFW market. Caesar kind of touched on some national trends and a little bit in the Dallas, but these kind of dig a little bit deeper into just DFW. The charts you're seeing are CoStar charts, and they likely look familiar as we've been using them in the presentations for the past several quarters. But we keep using them because we think they provide a pretty good context and some data on what is happening in the broader DFW area. Note that as you're reviewing these charts that they are all showing Class A and B property metrics only, and concerning occupancy and market rents. So the first chart titled Occupancy and Market Rent per Unit shows kind of focusing on the property vacancy rates and the market rents since 2019 with a forecast through 2028. Occupancy rates continue to drop through Q2. Market rents were relatively flat, but importantly, I think the fall in occupancy has slowed, and that's kind of what the chart is showing. You can see the slope has decreased from the previous quarterly update where it was much steeper, and it's it's still trending down, but it's definitely slowed. I think it's important to note that CoStar was projecting a stop in the fall of occupancy starting in Q3 of this year. Now they've kind of pushed that out going into the end of the year. So while it's a projected to be a small drop, it's still a drop. Our guess and kind of what we're seeing would be the change in forecast is mostly due to the supply dynamics, which we'll touch on in the next slide. But there's some the supply dynamics, and then also just seasonal leasing trends as we transition into the fall and winter where it's historically slower. So that's something we're keeping an eye on. And then the second chart on this slide titled Market Rent per Unit and Rent Growth, also showing Class A and B property market rents per unit year over year, and since 2019 with a forecast through 2028. So as you can see, the Q2 2024 was the 5th consecutive quarter of negative rent growth. Again, comparing this chart to the same chart last quarter, the outlook actually has not improved, got a little bit worse. Last quarter, CoStar was projecting positive year-over-year rent growth beginning in Q2, but now does not project year-over-year rent growth until 2025. So this change is a little less unexpected than the vacancy projection change that we discussed in the first graph. The reason is that I think we touched on it before, but residents who moved into apartments during the run-up of 2021, 2022, and even the first part of 2023, they continued to turn over, and they had signed at such elevated rental rates that whenever the lease trade out, we're moving new renters in at lower rates, and that's happening within our portfolio. It's also happening in the broader DFW market, and I think there's this is going to lag for a little while, maybe another quarter or two, as those transition as the average kind of renter stay is, a little over a year, and some, 2 to 3 years. So, however, I will point out that, and discuss it in more detail in the next slide, that the next slides, that HLC is not experiencing, continued downward pressure on market rents at all of our properties. Our experience is really property by property, and, and there's a big difference between the Class A and Class B and the various submarkets we're in. So we are seeing more signs of a flattening rents, not necessarily a decline, maybe some modest growth at most of our properties, but not all. So we want to move to the next slide. Yes. So, the final slide, similar to the slide that Caesar presented, although just focused on DFW, is kind of the absorption and supply rates in the DFW market. So Q2 once again had, record new unit deliveries. However, absorption rates were also very high, and certainly exceeded expectations that were put out last month. So they weren't quite high enough to fill all of the new unit deliveries, but it was still a pretty positive sign, in my opinion, that the demand in the DFW market is strong. Looking forward, the deliveries will likely continue to outpace absorption rates all the way into 2025, but at a much lower level, both deliveries and absorption rates compared to what happened in the last quarter. So 2025 appears to be the point when everything kind of changes, and we will likely to see some better absorption rates, maybe outpacing supply, and then at that time, hopefully some rent growth that'll come in. There's the kind of the slogan, survive until 2025. It's been a bit of a theme, but certainly looks that way in the data here in the Dallas-Fort Worth market. So moving to the next slide. Okay, so this slide is kind of focusing on our the leasing trends that we're seeing within our portfolio in Q2 and a little bit of Q3. So again, our portfolio is, our performance is kind of fairly consistent with the broader DFW market. Certain submarkets where we operate have really outperformed others. And overall, we're performing, I think, a bit better than the macro data. But starting with physical occupancy in Q2 2024, our average portfolio physical occupancy was approximately 93.3%. This was an improvement of over 1.5% from the Q1 average. So I think the most positive takeaway from the quarter is that the average occupancy, almost reached 94% in the month of June, and that has kind of carried forward into July and now into August, at the portfolio level. Historically, there is a bit of a slowdown in the early fall, which may impact our Q3 occupancies, but as of right now, most properties in our portfolio are well positioned in terms of current occupancy and our expected lease expirations in the fall and winter months. And in fact, 4 out of 5 of our DFW area properties are actually 96% or higher in occupancy levels at the moment. That fluctuates pretty quickly, but we're seeing a lot of strength. The one exception being the Farmers Branch submarket where Layers Galleria is located. That seems to be a more challenging market for us, but overall, we're seeing a lot of strength. Moving on to the economic occupancy, as the chart shows, economic occupancy only improved modestly in Q2 for us. Although physical occupancy improved more, the use of concessions and somewhat unexpected increase in delinquency rates weighed on economic occupancy. So as far as concessions are concerned, we've seen concession use change a bit over the quarter. Properties we track, our competitive market set, have often employed deep but temporary concessions, and this was different than the strategies that were being used before, which were consistently deep concessions. So we're seeing, in my opinion, an improvement in the concession market, but they're still there. And at any given time, I would say half of our competitive market set is offering some form of concession, sometimes as deep as 2 months still, but then they'll quickly pull it back to $500 off or something along those lines. So it's a little bit of a different strategy as opposed to, hey, it's a month free for now until the foreseeable future. We're just seeing, I think, a more strategic use of concessions depending on a property's occupancy level. Delinquency is a bit more concerning, as we've seen kind of an uptick across most of our properties, and we're not 100% certain of the cause. Application fraud is one of the items that we've been tracking. We catch a lot of application fraud, but perhaps we don't catch it all, and some of those turn delinquent. It's a possibility, and maybe reflected in this a bit. And also, we've seen a slowdown in processing of evictions by the courts. This particularly has impacted Republic Deer Creek, where that jurisdiction just seems to move very slowly compared to where it did, let's say, a year ago or even 6 months ago. They've slowed it down. There was a change in the judge there, and things have changed. So we're starting to see a uptick in overall delinquency. Again, it's kind of a new thing. Just was a Q2 kind of blip, or is it something more of a trend we'll see over the time? But we need a little more data to kind of fully understand it. As far as our new lease rents and our rental and our renewal rents, the new lease rents over the quarter has remained slightly negative within our portfolio, really since March of this year. This is not factoring in concessions, which would push the rent growth even more south. But again, not all properties have performed the same. Overall, we continue to struggle to increase rents primarily at our Class A properties. Likely, that's going to change as these concessions move out, but in the current environment, perhaps Q3 and into Q4 it'll remain. So that's kind of the downward pressure. As far as renewal rents go, though, we're seeing continued strength there, not as strong as it was in the past, but certainly we're seeing positive year-over-year rent growth in our renewal rates. We haven't had to offer very many concessions in renewal rents either, so overall it's just been a positive area for growth for us, and has offset some of our decline in our kind of new lease rents. I think as you look at the final chart there, it shows our renewal percentages in 2024, with also showing 2023 and 2022. As you can see, we've kind of improved considerably over the second half of 2023, and we're back in line with where we normally expect to operate, somewhere in that low 50% range. And I think that's indicative of a kind of the market kind of bottoming out. Renters aren't as apt to move to kind of price shop because the prices aren't, the concessions aren't any better somewhere else. And so people are kind of sticking around a little bit, and that's a positive sign, I think, going forward. Okay, we can move on to the next slide. All right, so Q3 and beyond, on this slide, I've highlighted some of the items that we're tracking as we move further into the second half of the year. As noted on the slide, occupancy has improved in almost all of our DFW area properties, and we feel generally that we're in a pretty strong position moving into the fall. We do have some exceptions, but overall, our occupancy levels are in a great place. As I noted, there was we're about 95 to 96% plus at occupancy levels at most of our portfolio, so that's positive. So as we move into Q3, we are certainly at a portfolio level, in a good position. As some may recall, in 2023, we actually saw a dip in occupancy starting the fall, and it lasted through the winter. Some dip this year is probably inevitable, but we feel that just kind of looking out at kind of where we are now, and then our expected expirations, that we will probably weather it much better this year. As far as rents and concessions go, though, it's going to remain challenging just due to the seasonality of the leasing trends. So I think the deep discounts that we've pushed at a lot of properties in terms of our rental rates is kind of over. We've increased some of our rents going, let's say over the last 3 to 4 months. And so I don't think rents are going to drop too much more. Concessions will likely remain. I think, most notably, Republic Deer Creek and the kind of the South Fort Worth submarket has allowed us to really push rents back up. We're not quite to where we were at our peak, but we are moving in that right direction. So there's some positive signs out there, but it's really submarket by submarket. And I think, as the winter goes on, or in the fall and the winter go on, we'll see some hopefully overall positive movement, but there'll certainly be divergence in kind of the performance of individual properties. We're also focusing on operating expense. With inflation, we've had some significant increases in our costs across kind of the portfolio. In response, we've been trying to leverage our portfolio with vendors in the DFW area, and we're also focused on eliminating any expenses, platforms, et cetera, that we just don't need. A good example of this is we at the end of Q2 we ended our CRM platform for the multifamily properties. After kind of doing an extensive review, we determined that our leasing AI platform actually provided enough CRM data for us, and so it was a cost we felt we could cut without really losing any information that we felt was critical. So that's what we're focusing on. Like, hey, is there redundancy here? Is there some other option that's just cheaper? And we're working hard on that. And finally, as noted on the slide, we're also working to keep our largest expenses down, which is real estate taxes and insurance. Insurance is kind of behind us for the year, but real estate taxes are ongoing, and we continue to pursue discounts and reductions through litigation across our portfolio in the DFW area. So it's a big focus for us, and also keeping our capital items and improvements down to kind of the minimum. Really focusing on just maintaining where needed, and not as much on new projects, at least for the end of the year. So I think that's it, and appreciate everyone's time, and I'll turn it back over to Kevin.
Okay. Great. Thanks, Caesar and Dave. We do have some questions that are rolling in here from the audience. So again, just a reminder, if you have any, please feel free to drop them into the Q&A module, and we'll try to get to them. So let's jump into this. The first one jumps right into a hot topic of Fed rates. Says, how would a Fed rate cut influence HLC's acquisition and financing strategies in the near term? Sounds like something, Caesar, you might be able to tackle with that one.
Yes, absolutely. More than happy to. So in terms of interest rate cut, I was joking with my friend earlier that I went away on vacation, went to Disney, and before I went to Disney, the 10-year treasury was around 4.5%. I turned off my phone, did not look at it. A week later, when I turned it back on, it was below 4%, and it was like, wow, this is pretty magical place. Went on vacation and interest rate cut. So and my friend was joking with me that maybe I should go on more vacation and we'll be in a good place. All joking aside, when they think about interest rate cut, it actually is a net positive for us in terms of a couple of things. When you come to Class A multifamily property, the spread between what the seller is asking and us can buy was quite wide back in the day because of interest rate. But now with the rate cut, it's make our borrowing costs a little bit cheaper, and also allow us to generate the same returns at a slightly more compressed cap rate and narrow the gap between the sellers and buyer. So in Q1 of 2024, I did all the Class A deal that came across my desk did not make sense at all. We are around 15% below what the seller is asking for. But now that gap has compressed to maybe 5%, between 5 to 10%, which is a great sign because that's a distance where we can strike a deal with the seller, given the right terms. And on the Class B properties with the distress deal, the 25 or 50 bip reduction in Fed interest rate, not going to rescue those deals. So those deals, so quite, is the owner not going to get out and break even. They're going to have to take a bit of a haircut somewhere. And that's where we are very bullish on opportunity because throughout the first half of this year, we've been seeing a lot of distress, Class B multifamily, that coming at a fairly attractive basis, overall cost basis that we've been chasing those deals. The main challenge, though, is that there's another player in play, which is the lender in place. Some of those deals, the lender will not willing to take a loss on their note, which is make the negotiation a bit more challenging. But now with the rate reductions, we can in certain instances we can pay at par value of the note and take the deal off the plate from the current sponsor, and we just work directly with the lender and buy those deals at a good basis. Those are where I think we can see a lot of opportunity. Continue to focus on tier 1 and tier 2 market in general. That's it.
Great. Yeah, sounds like a lot of opportunity there. This next question says, Dave, you mentioned economic occupancy. What strategies are you using to maintain economic occupancy amid renter affordability concerns?
Yeah, good question. Well, I think, as far as affordability concerns go, I think it's important to point out that, rents have dropped and concessions are in the market. So while affordability is still an issue, it's certainly not the issue it was back in, 2023 anyway, or 2022. So in some sense, market conditions themselves have kind of adjusted to kind of help with the affordability concerns of some renters. However, it's still an issue, I would say, and I guess one of the strategies that we've used, which is not ideal. We don't like to do this, if we can avoid it. But one of the strategies we use is to kind of actually reduce our income requirements. So typically, our income requirements for property are 3 times the rent amount, and in certain markets, whenever we've noticed that renters or applicants are missing because they can't hit the income level, or that's where we're losing them in the process, we have reduced it to 2.5 times the rent amount. So don't like to do that. Certainly, diminishes the credit quality of the tenants at the property, but I can't say that we've ever seen really an uptick in delinquency as a result at those properties. It's not really been measurable. So not sure if it's what the overall impact is. It doesn't seem to impact the numbers so much, moving from 3.0 to 2.5. And so in some sense, it doesn't necessarily help people, pay the rent, but it helps them qualify. And if, trying to maintain the occupancy numbers, it's one of the strategies that we've used.
Got it. Yeah. There's a question here on a similar topic, more on the labor side of the house, but how is the current labor shortage affecting some property management and renovation timelines?
Yeah, so good question. Yeah, certainly labor shortages have impacted some of our projects. We work closely with our contractors, and on our bigger projects, we certainly have seen some delays in terms of when they could start a project they're trying to finish up, and perhaps those delays wouldn't have existed, before the kind of the labor crisis started. I would say we've been more impacted on our property staffing in general. The property teams, just open positions have been sitting open a lot longer. They're hard to find qualified applicants, and then there's also been a lot of upward pressures, everyone's aware, on wages. So those two items, really kind of the wage inflation and the difficulty finding qualified applicants who kind of complete the whole process has been much more of a concern to us than kind of the wait time on contractors and some of our third-party vendors. Both are real issues, though, but the more immediate need has been kind of at the property level and on our property teams.
Great. This one here says, Caesar, you talked quite a bit about the Sun Belt and the supply and demand. If oversupply in the Sun Belt becomes an issue on acquisitions, how are you mitigating the risks of sort of a prolonged or longer lease up period?
Great question. So on our end, we still very bullish on Sun Belt market just because of overall fundamental, strong population growth and job growth will always drive higher demand for multifamily. Obviously, the supply, as you can project over the next couple of years, you will have that peak in 2025 and start to drop off in 2026. So from our underwriting perspective and also our budget, we always budget a higher than normal concessions for the next couple of years, maybe 3 years, depends on the sub-pocket. If we look at overall, like how many building being coming online, and make sure that there's adjust for that. And also, if depends on the sub-market, we will assume muted rent growth, essentially no rent growth for the next couple of years in our pro forma And after that will be like 3% rent growth. Just to factor in, you know, the overall macroeconomic of the cities that we pursue deal. And you know, that's a conservative approach that we always use on all of our underwriting. And which linked to my last point is that, you know, you make money on the buy, so you have to buy at the right basis to be able to absorb all this, you know, concession and no rent growth for a couple of years, and still, you know, and still generate a mid-teen IRR, you know, and a decent cash on cash investor. So that's what we are doing on underwriting, and also budget, you know, extra capex, have a bigger buffer in our capex budget upfront to make sure to, you know, factor in any unforeseen circumstance. So those are the things that we are doing on the front end to make sure that we get the right deal plus.
Great. So we have time for about one more question. And this one seems to deal with cap rates and sort of the outlook there. Do you foresee cap rates rising, and how would this affect your acquisitions and operations decisions? So it's kind of maybe for both of you guys if you want to tackle that.
I can tackle that first and then have Dave kind of close it off. So in terms of cap rate, you know, as where we are in all of our underwriting, we always assume cap rate expansion at exit by default. You know, if a Class A multifamily in prime location today is 5 cap, if we exit 5 years from now, it's going to be 5. We usually assume, you know, between 5.25 to 5.5 cap exit cap for on the exit by default. But you know, when I talk to other player and also economists, and you know, everyone views that with the Fed reducing interest rate, you know, that certainly help with cap rate, you know, not elevate too much on exit. And you know, some folks are assuming cap rate stays the same level at exit. For us, though, we are a bit more conservative. We always assume some level of expansion in our underwriting.
Yeah, and you know, from an operations perspective, not much to add to what Caesar said. I would just say that, you know, as you know, cap rates rise, it puts more pressure on operations just to deliver you know, results, you know, to kind of offset that declining value just based on the cap rate. So you know, we're focused on what I just talked about, you know, raising rents, pushing NOI, cutting expenses, everything that we can to kind of offset this kind of you know, cap rate increase that we've seen over the last, you know, couple of years. So I think that's really, you know, it just goes with operations mission in general, and you know, but it just kind of puts a more of a focus on that, since we can't count on, you know, declining interest rates to, you know, increase values into the current market environment.
Okay, great. Yeah. Okay. Well, we're just about up on time. I want to thank Caesar and Dave for sharing their insights, and certainly all of you for attending today. If we didn't get to your question here on the call or on the webinar, someone on our investments team will certainly be reaching out to you directly. Keep an eye out for some follow-up from us in the coming days. You'll get an email with some more content, some great insights, and keep it rolling there. If you do want to learn more about HLC Equity and our investment offerings, you can always visit hlcequity.com, or certainly contact one of our investor representatives directly. So I think that wraps it up for us. Dave, Caesar, anything else to add, or?
No, that's it. Appreciate everyone's time.
Thanks so much for your time. Have a great day.